It's over, people. The US jobs report for July came out just now, hot off the press, and it has crushed the world economy, at least for now. The Japanese markets, the European market, the US stock market, all down. Hell, Bitcoin is through the floor, which, damn it, I just thought I finally recovered on that. And I'm getting hit with DMs with one question. Does this mean the DR housing market is about to crash? Yes. Duh. Now, today's video, I'm gonna share exactly what happened with the jobs report, what this really means for the DR housing market. I have 3 things that you all need to keep in mind as investors. I implore you, please listen to that. And at the end, I'm gonna share what I think is the right move given the economic conditions that we're in. So let's get going. All right, so here's what had happened in July per the jobs report. Dan, let's throw some numbers up on screen. First, fewer jobs were added. So it was 114,000 jobs instead of the expected 175,000 jobs. Second, unemployment ticked up from 4.1% to 4.3%. This is still historically very low, but when we're in this space of like,
it's gonna be a recession, it's gonna be a recession,
every little bit creates panic in the market. So that little 0.2% increase, panic. But here's the deal. In July, when you get within the numbers, there was a higher than average expected layoffs. In fact, unemployed people increased by 352,000 people. That many more unemployed in July. But 249,000 of those, so most of them were temporary layoffs. And you know what happened in July? A ton of weather. So Hurricane Beryl and what it did in Texas created a lot of temporary layoffs, which makes the jobs report look not very good. But here's the kicker. This is the interesting part. There's over 420,000 more people entering the job market. That is a big number, and that number contributes to increased unemployment. Real quick, here's what that means. I'll try to explain it without being overly intellectual because I don't quite understand it. But let's say there's 100 million adults in the United States. If 90 million adults have jobs, then that would be a 10% unemployment or 90% employed, right? Except unemployment rates and all of that takes out certain people that are not participating in the job market. So if you've been looking for a job and then you stop looking for a job, I have no idea how they even derived that. Well, then they take you off of that 100 million. So let's say 5 million people stop looking for jobs. Now it's 90 out of 95 million, which is less than 10% unemployment, whatever that number is. So the whole point is for a number of years, especially post-COVID, the number of people looking for jobs or like in the job market was pretty low. And now you're starting to see a higher labor participation rate. You're seeing more people going for jobs. In fact, we're at an 84% labor participation rate, which is like historically high. Hasn't been that high in a very long time. I think 2001 was the last time it was that high. So all that means is that this report is not just saying, whoa, there's less jobs than we thought. Freak out, everybody. What it's really saying is, yes, there's less jobs than we thought. Yes, there was this weather event creating more temporary layoffs, reducing amount of people that want jobs that don't have them. And there's more people looking for jobs. All of these things happening together, bad jobs report. Now, this is all on the heels as well with the Fed signaling that, hey, we're not going to reduce rates probably till December. I think Jerome Powell literally said, keeping it flat, 5.25, 5.5 as a base rate until December. Now, I would have said that they were going to reduce them in November by a quarter point. In fact, somebody commented that they thought they were going to reduce it a half a point in September, just like 2 days ago on one of my videos. And I was like, that's crazy talk. It'll be November and it'll only be a quarter point. Well, I'm gonna take back what I said. Whoever you were, I think you're right, but we'll get to that in a second. So anyway, this jobs report comes out, the world sees it. It's an indication that we're heading toward this recession that we've been waiting for and hoping for in some ways, it seems like, over the last couple of years. We've been on the brink of recession, I feel like since 2021. Maybe not literally, but at least the news and the economists out there, all the indicators seem to be like, we should have hit a recession by now. So if we haven't, it means we will. And of course, we will. It's going to happen at some point. Recessions happen. So this then created all the DMs and all the questions about DR real estate.
Oh my God, is it gonna go down? Is it gonna crash? Is it gonna, huh? Who?
And of course it is. Of course it is. Markets correct. I hope that's not news to most people. Markets correct. The issue isn't the market. The issue isn't the market correcting. The issue is really 2 things. One, it's your investor mindset. If you are a short-term person, then this is gonna freak you the F out. But if you're a real investor, which is long-term, completely different beast. And the second thing is whether or not you have a job through all of this. I guess, shit, I don't have a job, so maybe I should be more worried. We'll see. By the way, if you're new to the channel, it's a great point to say. My name's Jamie Gruber. Appreciate you watching. I quit my corporate job in 2021 and moved with my family to the Dominican Republic in 2022. And I share the adventure my family is on this channel. I'm also a real estate investor. I bought and sold 41 units of my own, and I'm a syndicator, which we won't get into all of that. And also, to be clear, these are my thoughts that I'm going to share with you. I'm not your financial advisor. I'm not an expert on real estate. I'm giving you what I see as a guy who is a general practitioner in the space. That's me. That's my disclaimer. Let's get back to it. Oh, and one more thing. Be sure to subscribe, hit the like button as well. It helps to grow the channel. And because I don't have a job and I might be out of money soon, I guess, because of this jobs report, every subscriber helps. Please? Actually, don't worry about it. No, worry about it. Just subscribe. Back to the show. So look, when the world economy crashes, people hold their money. That's just the reality of it. So non-essential expenses get scrutinized more by the buyer. As a result of that, there's less buyers in the market. There's less demand for the supply that's available. And when there's less demand for the supply that's available, those providing the supply, in other words, somebody selling real estate, needs to sell it for less. Hence the crash. I think when people think of a crash, though, they think about 2008, through the floor.
It's going to hell. It's never going to come back. Oh my God, it's the apocalypse.
Crash, correction, it happens all the time. In fact, I'll show you that in a second. But an economic reset, a recession, whatever, is definitely going to have an impact on the amount of demand there is for the supply. Therefore, the pace that the Dominican Republic has been going at might cool off for a little while. But here's 3 things to keep in mind. First, housing is cyclical. It doesn't always just go up and to the right. In fact, let's take a look at this. This is the Fed economic data from the St. Louis Fed. All housing in the United States, I don't have this data for the Dominican Republic, not specifically housing prices over that time frame. Got some construction cost stats and that kind of thing. But for this, you can see the line from 1980 all the way through 2024. And what you see is this line, this line is not flat. It bobs around. More volatile in the last, say, 25 years for sure, but it's not a flat line. So keep in mind, real estate is cyclical, but over time, as you see, it goes up. Which brings me to my second point. Investing in real estate is a long-term proposition. In fact, investing in anything is long-term. Trading is a different thing. Trading is like getting in and out of positions, whether it's stock or real estate, in a short time frame. It works until it doesn't work. Investing is a long-term game. Let's take a look at this. So let's assume I bought a property in Q1 of 2027, right at the peak prior to the '08 crash. If I'm investing long-term, not trading short-term, and I'm gonna hold on to this thing for a while, well, if I sell over here 6-7 years later, Q4 2014, I'm doing all right. I'm up versus the purchase that I made. Plus, I've paid down some debt on this property and I'm in good shape. But if I only had a 2 or 3 year outlook on the investment and I'm selling right around here, no bueno. But flip it around. If I started here in '02 and sold in '05, oh, I'm a genius. That's what's happened over here. If you bought in 2020, 2018, 19, and you sold in 2021, 2022, absolute genius. But if you bought in 2022, you might feel like, I haven't really seen progress on my investment because it stayed fairly flat over this time. But what you notice overall, the macro trend is that it goes up over time. So that second point is essential. Investments are long-term. Trades are short-term. If you're an investor, you're gonna be just fine. And then third and lastly, you need to project the future smartly. This is where logic needs to come in. I'm gonna tell you a story about a property I bought in 2005 for $142,000. I put in a new kitchen, new bathroom, painted it, replaced a sewer pipe and a sewer pipe. I don't know what the hell that was. And did all of that, selling it 16 years later in 2021 for $95,000. That's right. A $50,000+ loss on that home. I was 25-ish when I bought it, and I wasn't projecting the future logically. Here's what happened. I bought this house on the edge of what is a crappy area and what was a nice area. Probably like 3 blocks from the crap, so what felt like far enough away at the time, and everything over here was really nice. Now the town was Elmira, New York. And Elmira, New York at the time and to this day is going from good to bad, not bad to good. In other words, it ain't a gentrifying city, it's the opposite of that. All the crap is expanding out into the nice, not that the nice is pushing into the crap. It's a really weird but effective way to describe it. I think you all get it. So over time, I'm holding on to this thing and holding, because real estate always goes up. I mean, look. It always goes up. 15, 16 years? You know it's gonna go up, but it never did. So as you look at the future and you're buying in Punta Cana, in Santo Domingo, or whatever, what you have to decide is where you're looking, and/or is the Dominican Republic real estate market in general, or even the sub-market, Punta Cana, wherever you're buying, is the crap being overtaken by the good, or is the good being overtaken by the crap? What's your good to crap ratio, essentially? Here's an example. Since I'm buying in Cortecito. If you don't know Cortecito, it's sort of the northern edge of the Punta Cana region. It's a beach town. It's known for tourists and parties and all of that stuff. But here's what also it has. It has grown exponentially over the past few years. It has some of the best restaurants in the entire Punta Cana area. There's massive development taking place there. The Palladium owns property there. There's historic restaurants like Captain Cook's and other spots like that. There's commercial development. There's all these things that are happening there. So when I look at that area, I see two things. I see a ton of development and I see some big time flaws. Yes, flaws. And I'm investing there because I'm looking at the future logically. Here are the flaws. It floods way too easy. They built all this stuff. They don't have the drainage. They need drainage. 2, traffic. There needs to be other outlets, other roads to get in and out of that area. It's just too congested, and as it's growing and more development is happening, you will need more roads or more infrastructure. 3rd, the roadway behind the beach needs to be shut down for walking traffic only. That might seem counterintuitive to roads, but that's not a good drivable road. It needs to be just a walking traffic area. And even more so than that, there's still like solicitation that happens on the end of Cortecito that I'm buying it. Meaning when you walk out the front, you're still gonna have people like wanting to sell you bracelets and this, that, and the other. Not great for tourists, but here's the bet I'm making. Do I believe with Palladium on one side, this giant multinational organization, all these restaurants and all these developers building on the other side, do I believe that in 5 years we're gonna be looking at it and going like, man, it was developing, everything was great, but they couldn't fix the drainage, so it's just a ghost town now and all that investment has gone away? No. The evidence that I have for that is the rest of Punta Cana. It's downtown Santo Domingo. It's the highway infrastructure. It's 911. It's roadside assistance. It's all the things that this country has developed in the last 4, 5, 8, 10 years. So when I say project the future logically, I don't have a crystal ball. I don't know. Maybe it will. Maybe Cortecito will flood out and it's going to be abandoned and my investment will go to shit. But more likely, in my estimation, it will continue to improve and the coalition of owners in that area will come together and put enough pressure on the government or whatever in order to make the improvements needed, because that's already what's happened. I'm going to show you a segment from an interview I did recently with a guy that invests in the Dominican Republic, and I'll share with you some of the nuggets to take from that. And then I'm going to tell you the one thing that I'm doing in this environment, in this investment landscape, with the idea that this market could plunge into recession and prices on real estate could drop. I'm gonna tell you exactly what I'm doing, and you can do it too if you'd like. But let's first watch this interview. What have you learned? What are some things to look at? You're buying pre-construction property.
Correct.
In Santo Domingo?
Yes.
What is your criteria? What do you look for in the developer? Or talk about that if you don't mind.
So I don't mind buying elsewhere within the country, but it has to be a referral.
Sure.
It has to be a referral. The track record needs to be there, someone that is established, and our price point needs to be there. So anything under $300,000, then I like to analyze. And depending who the builder is, again, I go back to that because it's just extremely important. And then I look at, okay, what is my end goal with this particular investment? It's like start with the end in mind. So always. Let's stop right there for a second. Start with the end in mind. So this is a professional investor. Juan, this is on my Grub with Gruber episode that I did recently. I'll link it down below. You can click on it, watch the whole episode. I'm only gonna play a little bit more of this, but start with the end in mind. When you're buying property here, there, anywhere, start with the end in mind. Let's see what he means. Always doing that approach, and what are the potential exits that I can have with this particular property or any particular investment. I'm always looking at not only one exit, but how can I unload this if I need to do that at any given point.
What are some of the exits? What are some of the things you think about with a pre-construction property?
I can sell once it's done, which I have done a couple of those, but
Flipped them.
yes.
So you buy them at 100 grand, let's say. By the time they're developed, they're worth 175, and you sell it. Do you sell it for 175, or are you selling for like 160, 165?
The max that I can.
Max you can get. Got
Max
it.
I can get, and then just reinvest those. I don't touch those funds. Just
So here, he did this a couple of times. Again, I don't know if his plan was to do that. He'll talk about other exits. But the point is, that is a short-term trade. He made a trade. We'll hear him talk about his ability to invest long-term. But on these, he decided, you know what, it's worth it to me to drain the equity and reinvest it.
just reinvest those. Then there's a couple that we just have rented.
Rented long or short-term?
Long term.
Long-term.
Long term.
Yeah.
So we went and refinanced and got a loan with the bank here locally. And we run those numbers to make sure that the rent covers that monthly expense.
Got it. All right, check that out. I want you to hear this. This is an important point that he just made. One, they buy the property, they buy it however they do, cash, then they'll refinance with a bank here. He's gonna talk about that in a second. He refinances with the bank to get his capital out, and then he looks at, okay, can I cover the expenses with a long-term renter? Now listen to me on this, please. If you are wondering, the strategy to ensure that you don't lose from a cash flow perspective on real estate here in the Dominican Republic, long-term renting, especially in Punta Cana, is such an underserved market. Most people buy it, they want to short-term rent it because they want to use it at different points. If you're in the short-term mindset, short-term on the investment, you're not able to use it, why would I buy it? I can't use it, I can't have fun with it. Fine, but if your objective is to move here one day, you're buying today for a 10-year move, buying and holding and renting long-term, that's an excellent, excellent strategy for you to advance toward what you're trying to accomplish. Let's see more.
And my basic strategy there is just to accumulate as many of those as possible, and then just unload them. Once it's time for me to be here a little bit longer, just buy a bigger place.
Are you on those, are you focused on equity only, or are you focused on cash flow?
Equity.
Equity. Boom. Okay, this is huge. Okay, you heard what he said, equity. I get these DMs often as well. So again, know this as we go into this recession. He's focused on equity, which means when he's got the opportunity to realize equity, whether it's a year, 5 years, 10 years, that's what he's in the game for. He's not in it for cash flow. Watch this real quick.
Yeah.
So as long as you break even, you're good.
Yeah. Cash flow here is basically non-existent.
Got it. Cash flow here is non-existent. Now, we can agree or disagree on that, but let me explain it in these terms. Because I've invested in deals in the United States, in the Midwest, and I've invested in premier markets like downtown Denver and LA, okay? Here's the difference between those two markets. When you're investing in an LA, a New York, a Miami, it ain't for cash flow. You're buying an apartment or an apartment building, which is what me and my organization buys. You're buying an apartment building, let's say. What you're doing is essentially saying, okay, this area, downtown Miami, over time is just gonna go up in value. I bought 20 units at $200,000 per unit, and now in 3, 4, 5 years, they'll trade at $400,000 per unit, or $350 if there's a correction, but I'm gonna be up. And I just make sure that I don't lose along the way, maybe make a little bit of cash, not enough to write home about, and then I sell this thing and realize the gain all at the end. That's a very different play than if you're in the Midwest. In Michigan, for instance, where I bought a 16-unit property once upon a time with partners for $755,000. That's less than $50,000, I think, per door, $50,000 per unit of those 16. We were able to sell it later because we forced appreciation. It was in terrible shape. We repaired it and did everything else. We sold it for more, but we cash flowed because the rents in the Midwest might be $1,000, $1,200 a door. In New York, it might be $2,500 a door, but I'm getting $1,000 a door in rent on a $50,000 unit. In New York, you're getting $25,000 or $3,000 on a $300,000 unit. So I'm making more cash flow in the Midwest, but my upside is limited. So what he's saying is, hey, I'm buying in growth markets. That's what I'm doing in Cortecito. When I buy in Cortecito, I have no plans to cash flow. If I break even, I'm happy. If I lose a little, that's fine. I want to make money. I'm gonna have to go really full bore into like short term or whatever. I'll figure that out. But it's not about the cash flow. I'm buying that long term to cash out at some point, whether that means refinancing if rates come down or selling it sometime in the future when it's optimal for me to, and then reinvesting those proceeds. That's what he means when he says he's investing for equity. I disagree that there's no cash flow in the Dominican Republic. It really all depends. If it's short-term rental, and you got a good short-term rental market, a good short-term rental building, and you're really good at it, you can cash flow. If you're buying in Santo Domingo Este at $40,000 a door, the rents there are gonna be like $500. You can cash flow. You just won't have the equity upside. So you choose, am I investing for appreciation? Am I investing for cash flow? Very rarely do you get both.
Yeah, unless you do Airbnb.
Sure.
It's
But
different.
there's work with that.
There's work with
There you go. So unless you do Airbnb, he's saying that cash flow is not something he counts on unless you do Airbnb, but then there's work to do Airbnb.
that. It's like running a business.
Yeah.
So I analyzed both of them. So and I decided, hey, Airbnb. We know a ton of men that are making a lot of money with those. But I decided not to be active with those investments. Same thing in the United States. Like I have several properties I transitioned. I think I mentioned this to you a couple of years ago. Transition to buy more commercial. On the commercial side, there's more upside. And in the United States, because I have bought a few buildings, and those buildings, I know exactly now the formula, which I didn't know this before. I know exactly now the formula that I can use to increase the value of the property and increase the NOI. And it's fun for me to do those. So
$1 of NOI could be $1,000+ in value.
it's insane.
$1. You raise rent. We're not going to get into all that. That's another lesson for another day on commercial real estate and how it works. There's a lot of terminology and all of that, but here's the gist. And this might be if you're not an investor and you look at your landlord like, oh my God, they bought the building. A lot of times the landlord isn't cash flowing a dime. You think they're making bank. They're not. They're not making bank on the monthly rent. They're able to pay their investors back. They're able to pay like an acquisition fee, and they're able to pay an asset management fee, some fees here and there. But what they're really doing is they're coming in, they're improving the property, they're boosting the rent, they're lowering their expenses to create more income. When they do that, it increases the value. So in 3, 4, 5 years, they sell it or refinance it, and then they realize the gain. But along the way, they're grinding. They're making sure that building performs for whoever the tenants are, grinding for very little, only to cash out at the end. That's how it works. They're not victims. It's a great game. And if you're in it, you can make a lot of money doing it. But that's how it works. Go down and watch that episode. If you want to see, he talks about mortgage rates and how he's getting mortgages both in USD and in Dominican pesos frequently, all the time. And he says with ease. So go watch that interview, Grub with Gruber. You'll really, really enjoy it. If you've already seen it, skip toward the end. That's where this discussion is. But anyway, that is the example that I could show you of the 3 things I talked about. Housing is cyclical. It just is. Yes, this recession, this correction will correct Dominican real estate. You'll see more supply, less demand. 2, investments are long term. And 3rd, project the future logically. Listen, the best way to buy here is if you can buy without worrying about whether or not you make any money on it. If you can buy and just make the payment every month, if not $1 ever came in on that property and you were good, that is the best way to invest, because you're going to do much better on that from a mindset perspective. You'll be in it the long game versus needing something to come in. Otherwise, you can't justify it, and then you want to sell it, but you're selling in a bad market. All right, now, what am I doing in this market? What am I doing considering the fact that the jobs report just freaking freaked out the world, that all the markets are crashing, that Bitcoin is down, that there's talk of recession, that there's likely to be a cut, an emergency cut to the Fed rate, maybe in September, maybe sooner, maybe a second one in December. Heck, it could be a full point by the end of the year in interest rate cuts, just to make sure this whole thing doesn't, topple off. Here's what I'm doing. I ain't freaking the hell out. That's it. Everybody needs to just settle. Listen, after 2008, here's what happened in the Dominican Republic. Everything stopped. The world stopped. Real estate stopped selling. So what happened? As developers started to really feel the pinch, they came up with a really, really interesting strategy. It's called seller financing. So they started to seller finance for those buyers that are out there in the market, which allowed for buyers to not have to get loans and mortgages and go direct to the seller in order to finance the property. Sound familiar? That all happened post 2008 in earnest, which kept things moving along. Cheryl Henderson is a friend of mine who's been a realtor in Punta Cana forever. She's like the OG realtor, and she said it. I've been through hurricanes. I've been through the 2008 crash. I've been through the 2020 COVID thing. I've been through all these corrections and recessions and downgrades, and it just keeps chugging along. You have to decide, do you believe that that is what the likelihood is for DR? Is the crap gonna turn to good? Whatever that means. Or do you believe that this is it? It's gonna stop and go the other way. If you believe the latter, we'll just have to agree to disagree. Let me know below. If you believe the former, which is, no, all right, I get it. This thing's gonna cool off. It might bring prices down a little bit, but in 3, 4, 5, 8, 10 years, yeah, you're right. It's gonna continue to go up. Areas like Cortecito are gonna get fixed over time. Maybe it won't be as quick as it might be in the States or somewhere else, but yeah, they're not gonna let that all go downhill. DR is just on too good a trajectory. That's what I believe. If you share that belief, then calm the F down. That's what I would tell all of you to do. This may make it, we'll see, may make it easier to negotiate price as a buyer. So you might be in the next 3 to 6 months, be in a great position to negotiate an amazing price as a buyer, as the market flips a bit to a buyer's versus a seller's market. So keep that in mind. But the world is going to panic. The world is going to freak out. The world is going to sell off. It's all speculation. Just stay the course. Do your best. Remember the other side of the bad stack. What that means is if there's 4% unemployment, 5% unemployment, 6% unemployment.
Oh my God, 6%.
That means 94% are employed. If foreclosures tick up, which they won't, there's way too much equity in the world. They won't go to 08. 08 was a once in a lifetime thing. We're not experiencing another 08. I think every economist would agree with that. Correction, not a complete drop off the face of the earth. But anyway, if foreclosures increased from 2 to 3%, it's like, oh my God, huge jump. But 97% of people aren't foreclosed on. Just remember that these things are going to happen. Freaking out over it, looking in the short term like,
Oh my God, well, I bought it last year, now the price is gonna come down. What's gonna happen?
just stay the course. Trust me. If your belief is that this country and this environment and this real estate market is only going to go up, which again, the only way you can determine that is look at the past. I say this often. If you bought in Cap Cana in 2005 at the peak, and then Cap Cana went bankrupt and threw all of its crap, and you're going to sell it today, you kept it the whole time, you're making a lot of money. Long-term mindset. All right, I'm done ranting and raving. I hope this makes sense to all of you. I'd love to hear from you. Let me know below what you think. Is this the end of DR and real estate forever? Or are we dealing with a correction and we just got to calm down? We as a community, me and all of you that talk to each other through these comments and everything, just support one another. Try not to let the monkey mind get sucked into the news, and just be smart moving forward. Buy at a price that makes sense to you. Leverage the fact that prices could come down, and if you're a buyer and you're cash heavy and you're able to buy, awesome. Get the best possible deal. Look at this as opportunity as the rest of the world freaks out. Let's not let that happen between me and all 16,000 of you or so. Now, if you'll excuse me, I'm gonna go apply for a job. Nah, I'd never do that. I'll see you guys in the next one.